Good day. For this point, I would like to discuss to you the answer on the question, what are the tools to be used in calculating financial ratios? Financial ratio analysis. Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements such as the balance sheet and income statement. Financial ratio analysis is the process of calculating financial ratios, which are mathematically indicators calculated by comparing key financial information appearing in financial statements of a business and analyzing those to find out reasons behind the business' current financial position and its recent financial performance to develop expectation about its future outlook. Financial ratio analysis is very useful tools because it simplifies the process of financial comparison of two or more business. Financial ratio analysis makes the financial statements comparable both among different businesses and across different periods of a single business. Financial ratios can be broadly classified into liquidity ratio, solvency ratios, profitability ratios, and efficiency ratio, also called activity ratios or asset utilization. Liquidity ratios. Liquidity ratios assess a business liquidity, its ability to convert its assets to cash and pay off its obligations without any significant difficulty, delay, or loss of value. Liquidity ratios are particularly useful for suppliers, employees, banks, and etc. Important liquidity ratios are current ratio, quick ratio, also called acid test ratio, cash ratio, cash conversion circle. Example, acid test ratio or quick acid ratio. This ratio will tell us the ability of the company to pay its current liability. This will measure how fast then can generate cash from cash itself, and the collection of accounts receivable or perhaps the discounting of notes receivable. Example of quick assets are cash, receivable, and marketable security. For example, we were taken from the records of Christian Joyce Enterprises for the period ending December 31, 2008. For cash, we have 20,000 pesos, receivable 550 pesos, inventory 450,000 pesos, prepayments 50,000 pesos, accounts payable 250,000 pesos, notes receivable 300,000 pesos. For formula, we were using quick assets over current liabilities. Quick assets over current liabilities. Quick assets, its mean include cash on hand or current asset like account receivable that can be converted to cash. Current liabilities are typically settled using current assets, which are assets that are used up within 1 year. It includes accounts payable, short-term debt, dividends, and notes payable, as well as income taxes owed. For quick asset, we have here cash and receivable. For current liabilities, we have here accounts payable and notes payable. For cash, we will be using 20,000 pesos. Receivables is 550,000 pesos. For accounts payable 250,000 pesos, and notes payable is 300 pesos. So in this case, both of them are quick assets. Quick assets. And these two are current liabilities. Tap and now quick asset cash. We will add this 20,000 cash plus receivable 550,000 equals 570,000 pesos. For current asset naman, accounts payable 250,000, notes payable 300,000, add 550,000. So, quick asset divided by current assets or liabilities. So 570,000 divided by 550,000. 570,000 divided by 550,000 is equals to 1.03. 1.03 or to 1. Interpretation. The above ratio means that for every 1 peso of a liability, there is a quick asset of 1.03 pesos to answer for its eventual settlement. The ratio looks good because this means that the company could easily source out cash for payment of its current maturing obligation, but as a manager or supervisor, we have to closer look on the other side of the coin. For example, if the company is a fast collector of accounts receivable, the 1.03 to 1 is too high because we can easily convert receivable to cash. Therefore, it is really a good indicator. Looking on the other side of the coin, we might not be able to tap a good credit facility. We have to remember that if we have not maximized our leverage, we miss the point of earning more and by doing more businesses to improve our bottom line figures.